So good afternoon, everybody. And thank you for taking some time to be able to be with us today. We've seen quite very sharp moves in recent days since the market was able to break out, and we'll talk about that in a little while. And let's try to be able to focus on how we can navigate through these conditions, especially when we're seeing a lot of volatility into the market. Okay, so we'll start with the PSEI index because, of course, this is where our bread and butter is going to be coming from. And I'd like to be able to point out that we've got a very significant move in the last couple of weeks when the index managed to be able to break out from this area here and off a very, very lengthy consolidation that was heading downwards. And this particular type of condition is really very important because after staying, very idle for such a long period of time, it groomed itself and eventually it punched out of that resistance in that breakout condition, and we saw a very, very nice sharp up move take place as a result of that particular breakout condition. Now, in the very short term, we've seen a very, very rapid up move take place. The market did make a correction, but fortunately, in that corrected movement, it managed to be able to stand above the short-term support, which I'm using the 20-day EMA to be able to hold that area. And then, of course, in the last few days, as you've seen, we've seen the market climb out very, very sharply and extending of course, the breakout swing that we had earlier on in mid-October. Now, as things stand, of course, I mean, things look really nice because, of course, we've had a powerhouse move by a broader number of issues. However, we do have to be able to understand where we are. We're not coming from the base anymore. We're coming from way up here after a correction and after a second swing. And this might require us to be a bit more prudent in what we do. So the reality check of this really is to be able to see that, of course, we've had a breakout swing, and after very, very sharp up moves, normally what comes after that is, of course, a corrective period. Now, I'm not saying that the corrective period is going to launch itself already immediately, although we'll try to be able to gauge where that particular thing will be. However, one of the guides that we will do is we've put the market into two different channels, one short-term channel, which is what you see here. And with the index being here, we're kind of near the topping end of that first channel that you see. In a wider or longer term channel, we have this one climbing up here. And if this were to stretch itself out to where it is today, the two resistance areas will be watchful of will be the first one, 6,750 to 6,8, which we're not so far away from right now. And the next one, just in case we manage to be able to punch through this, would be something closer to about 7,000 in resistance. And I'm thinking the second one would be a much heavier resistance to be able to deal with. And when you say resistance, that means that we'll anticipate that a lot more selling pressure coming towards that area. And we really have to be very watchful of that then. Now, another worry I do also have is given that prices are standing where they are today, how far is support away from where we are? So just in case the market corrects, I'd need to know where would that floor be? And that floor right now is still somewhere over here. It's closer to about 6,300 to 6,250. And if I were to measure the difference, that'd be something between 5.2 to about 5.9% away. And so I guess if you're asking me how aggressive I should be in the short term, I would say as of today, not too aggressive. And I would agree with April because if the market has a hiccup of a correction, you would anticipate that the market can pull back within that percentage that I mentioned earlier on. So try to understand the situation so that you know how much of a aggressive state you can hold. But there are a lot of issues that are not all resembling that index. So if you see that some are only beginning to move now, we may have rotational action that allow you to be able to generate some new positions in there while the others are making corrections. But please do understand that the broad market itself is showing a pretty overbought condition as well. And that, along with it being near resistance, should really be taken with a grain of salt. So I like what the movement in the short term is, but we've accomplished a lot. It might need to wind up a little bit more. Now, in my last few market outlooks, I've actually been using the German DAX, which I was following since 2016. And this 2016 sample I've actually been utilizing to give me a sense of what may happen in the Philippines. I'm using this as my benchmark. Now, one thing I want to be able to point out over here is I've been watching this since the time that made a W formation. As you see here, a W formation is a reversal pattern. And this normally reverses the downtrend that you see. And what happened after that was this striking up move that you see here in the German DAX, followed by a consolidation range, which lasted quite a number of months. Now, in comparison to where we are in the Philippine market today, if you notice again, we have also a W-like base. W because it generated a higher low here. And then we had a breakout, which I showed you earlier. And then, of course, prices striking up, very similar to what's happening to this area. So these two areas where you see there's a dotted box inside is roughly where we are today. And I just wanted to show you what happened in the German DAX after that rally. It actually consolidated for quite some time. And so this is what we call a staircase type of recovery. It shoots up very quickly, but it has to be able to price that in because, as April pointed out, the fundamentals are not backing up the valuations right now. So there's a high chance that you could have this type of correction later on. I'll talk about two types of them in a little while. So if we are like this into the Philippine condition right now, and we were to follow a staircase type recovery, what we're seeing right now is this rally accelerated move. And I think we just have to be prepared that after momentum starts to be able to slow down, you might get a sideways move or a reactive move that may come, and in an effort for the market to correct itself. Excuse me. So what would a corrective scenario look like? Now, I purposely did this in the chart of the index just to show how vertically aggressive the movement of the market has been. And if you can see, we come from the breakout price here, and we're all the way up here closer to 6,700, slightly off that right now. And this is where support is. And so there really is a distance that has to be able to be patched up. And I think corrections are the best way to be able to do that. Now, the two types of corrections I would anticipate would be as follows. If the market is resilient, it will hold off and generate a sideways type of correction, something similar to something like this. So you have an up move, and then you will see prices cascade up and down between this particular range. If you were to translate that into the index, it might bank off downward first from the high and then make a sideways motion. Now remember, we don't know what the interim high would be. This could extend a little bit more. We don't know what that is, but once it does it, then anticipate this is going to be that type of scenario if the market maintains its strength. Now, if it's not so strong and it goes to a typical type of correction, then what you saw here last time can be imitated, but perhaps not as lengthy. So what this will be, this will show you more reactive type of a swing, where instead of going flat sideways, it would cascade going down into a reactive channel. So if you go back to the index, you would see these two red lines. This would anticipate that it will be moving up and down. So similar to what you've seen in this particular orchestrated move. However, like I said, since we are a little bit better into the recovery situation, I would not anticipate that it will drop like this, and it should not take us long, right? But it may consolidate into these bands, but maybe for 2-3 months, it's quite possible because it needs for the fundamentals to catch up to the new pricing that prices have made. And as April pointed out, the P's are not really looking that as aggressive right now because they're still a bit pricey. So if you notice the moving averages that we have here, this is the moving average of the 50-day and 100-day EMAs. This is where I would anticipate major support to be. So if this were to correct sideways or particularly into a reactive one, what I want is I want this pullback in prices to stand above these two moving averages. And that should be able to tell me that the market is relatively well positioned to be able to continue on with this later on. Now, if we break these two moving averages, I will have to change my mind and I will build in a much more aggressive correction. But until that time, I am really looking forward that correction should stand above these two where they would be, hopefully in the next 2 or 3 months from now. So what I did is I wanted to be able to get a sense of, how aggressive and how strong is this market. I mean, April pointed out earlier that that SM prime alone could really be the big mover that could have kept an index quite strongly into an advance. But when I looked into the 30 lineup index stocks, I noticed the following factoids here. Number one, more than half of the 30 index stocks, that's 19 to be exact, are already showing very strong trends. And that means that they're standing over all their moving averages. Stocks would only do that when the momentum is starting to pick up and showing very, very good following and demand. So that's a very positive point. Second, 8 of the remaining 11 index stocks are actually below only one more moving average. So what that means is you only have really one point of resistance left blocking its particular path. And given that, the 8 of the index stocks that you see over here, if you notice the RSIs, I've drawn them in color red because of that, I've seen already 8 index stocks hit overbought levels. And that means you only go to an overbought situation and the market's moving very, very strongly. And so that's something that we have to be able to watch out, that the market in the short term is in a very dynamic mode. It's come from a very quiet period for so many months, and it's trying to be able to react to that explosion of a breakout. And now this is the reason why we're having such a very, very momentous move in many issues at the moment. So what is my plan to be able to do this? Well, of course, I think there's a possibility we could still continue, but there are a few headwinds that I want to be able to talk about that we want to watch also, or maybe even a tailwind if things work out positively. Number one, of course, is the US market. And I think it was the US market rallying in the last few days that really instigated the swing back into a recovery after the breakout. And the reason I'm pointing out is this is the S&P 500 index. And in the last few weeks, it's been looking quite dicey, and it generated what I call an ABC correction, or what we call an Elliott wave type of correction. Usually after an ABC, corrections usually can finish themselves. And this rally that we've been seeing, perhaps inspired by what's going on with US elections, have been taken quite positively by investors. And so right, we're at the top end of the range as of last night. And that means that we're going to deal with this resistance value, and we really need this index to be able to break over that area. Now, even if it does break, and that is a good sign, I think that since the push started from the bottom of the pattern, what you may see here, if a breakout does take place, it'll probably break out, then you'll see it turn maybe 1 or 2 days and then subside back in, could go all the way back into the pattern. But what we want to see is we want it to stand above its short-term moving averages. So this would be about closer to 3,400 in the S&P. And then after that, try to make a resuscitated move. So as long as we see that scenario, that will be quite uplifting for everybody else, and that will allow us to be able to continue. Hopefully, we can see the more aggressive targets into our resistance ranges. Maybe, if we're really lucky, maybe even extend up to 7,000. But like I said, 6,800 might be the first resistance area we might want to have to look at. All bets will be called off if this S&P 500 reverses its course and breaks below this ABC low. If we see this break below the 200-day moving average, that will change the mood out and sentiment will degrade. That will allow our correction to come inside and push the market back. Now, another headwind I'm also looking at is other markets would be, let's say, the German DAX, for example. Now, I'm looking at other markets because these are other markets that might influence us if they do very rough movements. Now, I'm worried about the German DAX because Europe, of course, experiencing this second or third wave in COVID exposure is starting to lock up all over again. And that's not good for the economy. And there's a reason why we saw a breakdown condition over here earlier on. But given the rally in the US, it allowed Europe to be able to rally back. And I really hope that this can continue much more into the upside to take this rounding top pattern off. Because when I see patterns like this, these are very, very dangerous patterns. And the last thing I want is for this to come back down here and try to draw in all the other markets into that depressed state. Now, the other market I'm also watching would be the Shanghai market. It also recently rebounded from major support, as you see here, thank God. And right now, it's here trying to be able to attack resistance. And I really hope that this could also break out so that that could lend to the bullish move. But if not, and we see this come back down here, just like this in the DAX, it might also add some pressure into the market. The other things also we want to be able to have a look at is the condition in the Philippines. Look at the Philippine currency. The peso dollar rate has been still very strong. And, I was thinking it might even rebound a little bit, but its rebound only took a very sideways glance. And that means that the currency is really showing showing a lot of strength. And if this were to crack the supportive area here, that would even go somewhere closer to about 47.30. So given the conditions here, this is still a very strong position for the Philippine currency, and it's not showing too much volatility. Here on the right side is the dollar index. So this is a dollar based on quite a number of different currencies. And right now, I'm still kind of worried about this because they're still talking about stimulus effects into the US that might draw on the dollar. So this little pattern it's building here could be similar to the pattern that it built over here, a temporary pause, and then maybe one more swing down to complete the nature of the decline. And so there could be added weakness into the dollar, especially if that stimulus effort comes out. And I guess a weaker dollar could only just improve the peso situation. So it could keep attention into our market and to maybe a few other emerging markets, while of course the US market corrects. And I hope that that is the breadth of what happens there. So in summary, I think I laid out still a short-term good condition. The PSE broke out of a very long consolidation, and I think that is quite significant. And we've seen the prices of the index go above the 200-day moving average, which is quite bullish into that aspect. But of course, as we said, and of course, I'm also taking to what April said earlier, we're coming towards overbought conditions. We're hitting next resistance levels, and there's a good chance that corrections from here may ensue. And so I would caution you to anticipate this to be more of a staircase-like of recovery and not just a lightning up move. And we've had that lightning up move already, and at least a good chunk of it, and there could be a little bit more, but I do anticipate that the correction may flesh itself out. Also, some markets out there might also provide some volatility here. So we will continue to watch out for any headwinds that may take place. But if none of those happen and things can normalize, and that should be able to give us an opportunity when the price corrects to be able to look for potential buys inside here. And of course, use our overall market as a gauge in your strategy in taking movement into stocks. I would still advise you to be very broad, not so broad in terms of it, but very selective. April has showed you that some of the banks are not really performing so well yet, and they're still undervalued, but there are issues that are moving much faster. So now, I guess you're going to have to ask yourself the question, I mean, if I just go into what is cheap, but running with very low momentum, it might take you a little time before you might get your price moving into acceleration mode. So what I would do is I would wait for some of these fast movers to quiet down and pull back towards support, and I will jump in there when I see those corrections take place. Because if they were strong now and they were more mobile now, I think they'll be more mobile again after the correction has ensued. So you might really want to be able to look at that particular type of condition. Also, you might think about taking some profits into an overbought condition so that you can have ammunition to buy back. So I think that's very key in this kind of market, because the market shouldn't be running away like the way it is, right? It's good that it did this, but I think in good time. Next, you want to be able to focus on buying closer to support rather than running after prices after they've broken out for so many days. So that's where the condition that you might end up getting a little bloodied in your nose if you don't know what you're doing. So try to be able to buy it when prices pull back. Use the 20 and 50-day moving averages to be able to suggest where the supportive areas are. 50-day for me is a bit more important, so I'd like that to be able to show you more supportive areas. But for those issues that have gone very, very sharply, more likely the 20 or 50 may really be the levels you want to watch out for in terms of picking off your stocks. Okay, so I just want to make sure that you understand. Of course, some of you may be scratching your head and wondering, well, what's going on, what changed, and why is the market so strong? And some of you might be saying, I don't believe that the market should be priced here. I mean, at 17 times PE, that might be a bit too high. Yes, I can understand, but sometimes the market might be irrational and stay irrational a little longer than what you would expect. And of course, as it says over here, it's important for you to be able to understand that it might be irrational because trends tend to extend over in time. But what you want to be able to do is make sure that as long as the trend stays in that direction, you're following it. And the minute they start to weaken and those trend lines start to break, that you're taking some profits off the table. Use that as some of your capital to be able to buy back when you see these support levels come inside. And as long as you follow that particular type of orientation, I think you'll be more than okay to be able to participate in this market that we've seen come alive most recently. So I hope that I've managed to be able to explain more what's been going on, and of course to be able to lay out what may lie ahead of us in the short term. And do keep track of the market now that, of course, it's become more active, and hopefully we should be able to profit more as we be able to lay out what our plan should be in the next couple of weeks and the next couple of months. So with that, thank you very much.